ETNs, ETFs, I guess ETPs, and most people, I think there are many people who don't know the difference between a mutual fund and an exchange traded fund. So you're uniquely qualified to decipher ETP, ETF, ETN for everybody.
Sure, yeah. Well, there's a lot in there to unpack, but maybe just briefly the differences between those products. So the Investment Company Act of 1940, right, came along after the 20s and 30s, where a lot of people lost a lot of money, and there had been a lot of scams out there and leverage and things. And so that governs how publicly available funds are offered in the US, right? And out of that body of law, we get mutual funds and a few other variations on that theme, like closed-end funds, et cetera. And I think it was in the 90s where the first ETFs were formed, and really the idea was kind of like everything these days, right? Things are getting more and more convenient and more rapid fire. So somebody somewhere said, hey, we don't want to be able to just buy and sell shares in our mutual fund once a day at 4 o'clock. What happens if I want to sell at 11 a.m.? And so ETFs were kind of came on the scene as essentially mutual funds that were given an exemption from certain rules in the 40 Act that allowed them to trade like a stock. And so you could list these shares on a stock exchange. And that gave people the ability to buy and sell these funds on an intraday basis. And of course, it's, sort of, I'm dating myself, but I remember when email came along and, everyone was fascinated by this idea of snail mail versus email, right? Now, of course, I get teased by my kids. I tell them, hey, yeah, just forward me that or send me an email. And they go, send you an email, Dad? Really? You want me to email you? Because they're all about texting, and not even texting, like messaging in Instagram or something. And so anyway, the world moves forward, but the financial world sadly takes a bit more time. And it's not all sad, right? A lot of that is about investor protection and being thorough. I think the regulators certainly want to be thorough. But innovation doesn't happen quite as quickly in the financial sphere. So in the 90s, we got the first ETFs, and that trend really has continued to this day. And ETFs have ballooned versus the more traditional mutual fund strategy. And that's partially because of the convenience of trading intraday, but it's also, there's a tax angle there. The way that ETFs actually work is they're much more efficient typically than mutual funds. There's, won't get into the vagaries of it, but a well-run ETF rarely distributes capital gains because it's able to pass those through to the market makers involved.